Alright folks, quick natural gas update. Here's what's really driving the market today, what's moving the market, what's noise, and what actually matters as we head deeper into the heating season. US natural gas futures are under heavy pressure this morning, continuing the sell-off after yesterday's sharp breakdown pushed prices decisively below the 200-day moving average. That former support near $4.45 has flipped into a clean, no-nonsense resistance level, and the market is treating it as such. Right now, nat gas is trading in the mid-$4 range. And honestly, the market looks like it's stuck between two powerful forces, booming export demand on one side, and relentless US production on the other. Storage is another key piece. We're currently sitting near 3.96 TCF, and while that's not extreme, it's enough to give the market breathing room. If the next couple of EIA reports come in with modest draws because of mild temperatures, that will reinforce the bearish narrative. On the other hand, one strong early season cold snap could flip sentiment fast, so traders are watching weekly reports like hawks. Let's start with supply. US production is still hovering near record levels as the lower 48 states are pumping out a massive 110 billion cubic feet per day, which is a solid 7.1% jump year over year. Even though the rig count is lower than it was 2 years ago, but drilling efficiency keeps climbing. Producers are squeezing more gas out of fewer wells, and that steady, heavy output is the main reason rallies keep fizzling out. Pipeline flows in key basins like the Permian and Appalachia remain strong, and we're not seeing the kind of meaningful drop-off that would tighten balances. For now, supply is a solid ceiling over the market. Demand is a split picture. On the bullish side, LNG exports are on fire. Feed gas flows are consistently at or near record highs, and US cargoes are moving aggressively into Europe and Asia. That export strength is a huge reason prices haven't collapsed despite high production. But the bearish drag is the weather. Forecast models keep leaning warmer than normal for large parts of the US. And if that holds, residential and commercial heating demand will stay softer compared to last winter. That's the single biggest risk factor for bulls. Warmer weather wipes out upside momentum quickly. Here's the short-term outlook. 45% chance we stay range-bound to slightly lower, roughly $4.25 to $4.50, as warm weather and strong supply keep things capped. 35% chance of a deeper pullback, especially if storage stays comfortable and models don't budge. And only a 20% chance we see a real breakout to the upside. For that, you'd need a sustained cold shift in the weather models or a supply disruption in a major producing region. So bottom line, the market leans slightly bearish in the near term, but the floor is higher than people think because LNG demand is so strong. This winter is shaping up to be a battle between warm weather and export-driven tightness. Stay flexible, keep your eyes on storage and model runs, and be ready. Nat gas loves to surprise. Feel free to buy me a coffee or YouTube super thanks if you'd like to help keep this channel going. And don't forget, watching the ads and leaving a comment really helps support the work I'm doing here. Thanks for being here, and I'll see you in the next one.